Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, I'm going to be analyzing CDW Corp stock, ticker CDW. This one came in by request down in the comments section, and I've been putting it off for a day or so because I wasn't quite sure how I was going to go about doing this. As always, this is not individual investing advice. This is just how I analyze stocks. So I haven't been following this stock. And the reason for it, even though if you look at the earnings growth, it's been really good. It looks like this past year was the only year that earnings declined, and that was coming off kind of the COVID boom where they had a couple years of 20% growth. And so it took me a little while to figure out kind of what I wanted to do with it. Now, normally what I prefer is I have the fast graph going back as far as it will go with the earnings, which is back to 2014. Which isn't too bad. It's like 10 years worth of earnings. But I really like to be able to see what a business's earnings have done during a recession, so I can get an idea of how cyclical the business is. And the reason that's important is because, well, we see a little bit of it here when earnings are falling a little bit. But if we had a recession or we had some kind of industry downturn, and instead of falling 5%, this year they fell 50%, and that was just kind of a normal part of their doing business, then we would be really careful about when we bought the stock, right? Just because it looks cheap after it's had a couple years, like say right here, okay, where the PE was 16 and they just had a bunch of years of 20% earnings growth. That looks pretty cheap. Let's say you average it out and you said, hey man, they're growing earnings 15% on average a year, and the PE is like 16, that looks good. Well, that's true as long as they could keep doing that, but it's not good if every cycle they have earnings fall 50% or 60%. Sometimes they can go completely negative on stocks. And maybe even if they come back, you have to sit through like a giant decline in the value of your stock, right? So earnings become a lot less useful, especially if you're projecting them out into the future at kind of a steady rate when they fluctuate really deeply like that. And if you don't have a history, you don't really know. So even a person who did that, and let's see, the PE is now 21, so it's actually risen by what, like 30% or something. So really just the multiple expansion is the only growth they've really seen since 2022 over the past 2 or 3 years. So that's what happens when you're kind of buying in the up cycle. Even though the PE looked pretty good, you would expect this to be growing at a better percentage. But really what happened is they had a year with no growth, and negative if you include inflation, and then another year with negative growth, right? So maybe that doesn't drop 50, but maybe it flattens out for a few years, and we don't know how long it's going to take to come back, and we don't have any historical reference really to look back and give us an idea. So normally I just kind of put stocks like this in the too hard category, but the problem is we haven't had a real recession in a long time. So there's a lot of stocks like this, and you kind of get to the point where you're going to miss out on some opportunities if you're not willing to kind of take a chance or, do a little bit more work and say, okay, maybe this is one that I might be able to take a chance with. So now I want to go and look for signs. Okay, what are some signs that this might be a deeply cyclical business, right? Well, the first thing I would do is scroll down to see what they do. Now, it says technology distributor, so that's kind of hard to know. I did a little bit more research. It looks like they're mostly into hardware, like technology hardware. That's typically a cyclical, at least moderately cyclical industry, right? It also explains why they had a couple really good years here that were better than the previous few. Although, 2018 was a tax cut year, so set that one off to the side. If you look before that, you have 17% growth, 12% growth, 18% growth, 8%, and then you have the two big booster years kind of with technology hardware where we get 20% plus growth. So we do that and we say, okay, there's a decent chance that this could be at least moderately cyclical business. And then of course now you could have made that assessment, I think, even 2 years ago, right? And now we can actually see signs that at least some of that's happening, right? So we want to be a little bit careful here, putting too much emphasis on the PE ratio, which isn't really cheap at 21, but they've had really good earnings growth, right? So let's keep all that in mind, and we'll try to come up with some reasonable assumptions here. So I think what I did is I said, okay, this is like 30%. And so, which they haven't really done since then, other than the tax cut year. And so I might have went back to, I think this is what I did. I went back, I knocked off those first two really fast growth years and kind of went back to the era that I was talking about. Now, keeping in mind, this doesn't have like a true recession. It has a little mini one in 2020. But that gets made up for with the post kind of pandemic boom. And then we have a tax cut year. So those are all going to work in favor of them. We do have a couple years of kind of normal readjustments from some of that boom. So I think this is like a fair time period to look at. When you're using fast graphs, it's really important to put some thought into the time frame that you pick, because that will determine what your earnings growth rate is going to look like, right? So this is 13.14%. If I use just the maximum, well, I have to bring it forward because they don't have earnings that year. But if I do that, that's going to look forward to what analysts think. It's going to start all the way back in 2014, and that's going to give you 15% expected growth rate. And if you shorten it to just knock that off, that's going to give you 15, right? So it's going to be a little bit higher. So I'm going with the 13.14, which I think makes the most sense. And that's going to be this time frame right here. And in the back of my mind, I'm going to think, okay, this is probably a pretty optimistic earnings growth rate. If this downturn gets bigger or we have a recession, we know that the downside potential is pretty high for this one. And there's a little bit of evidence for that. And that is, if we go back to the 2020 decline, we know the market fell maybe like 30% during this time. And so when you find a stock who falls more than that, which they fell 45% in 2 months or something like that, that's usually a sign that the market is punishing them more, and they could have more cyclicality or a little bit more debt sometimes. And so, but the market will tell you probably how it's going to treat it in the future if some similar fears kind of come. And it doesn't have to be a pandemic, because nobody knew exactly what the pandemic was going to turn out. They just knew it was going to be some kind of downturn. So we should assume, I think, that this is a riskier stock to buy near the tops of cycles, or when you don't know that you're in a down cycle for sure yet, than your standard stock might be. It looks like I'll look at my actual debt calc. I think it was like 22% was the difference between the total enterprise value and the market cap. That's what I use to kind of estimate their debt. It says their long-term debt to capital is 64%. That's not like crazy high, but it's high enough that in a cyclical business, it's going to move the stock a lot. So usually. So they have enough debt. They have enough previous kind of signs from the market that I think the stock will sell off pretty deeply in any kind of like downturn, right? It'll sell off more probably than the wider market. It's kind of already happening, right? Because they peaked out here, and even with the comeback that they've had, they're still down over 20%. Let's see what it was just. So it was down about 30% just last year, like basically within the past 12 months. So we see signs of weakness when the market's kind of making all-time highs. All right. So even with all that set up, I'm going to try to do a little bit of just putting some numbers together for a time until payback valuation. So the idea with this is, and this is just to kind of get an idea of, if you were going to try to see if the stock was over or undervalued right now, you could just look at it and maybe compare it to the rest of the market and get some kind of idea where it's at. So I used that 13% earnings growth rate, which is optimistic, right? If you look at where analysts are, let's widen this real quick. They're at 7% next year, 9%, then 17%. So they're probably like 10 or 11 over the next few years is their expectation. So I'm above that in my assumption here. And then I also what I do, let's find my debt adjustment. So I showed you the difference between the market cap and the total enterprise value. I'm adding 22% to this stock price for valuation purposes to account for that debt. So the idea here is you buy the total enterprise value of the business. What is this business, how long will it take the business to earn back however much you paid for it? So let's say you pay $100. How long would it take to for the business's earnings to earn $100 in earnings? So what we do it, and I'm assuming earnings are gonna grow at this rate. So earnings I have at $10.07 a share, which are forward earnings, so this is again going to be optimistic. This is looking at 2025. I'm pulling those forward. So I'm pulling really a whole year's worth of earnings forward. And then I'm going to assume they grow 13%. So I'm being even more optimistic. So it's going to start from a pretty high base. Let's see if I'll have to scroll to find my, so the earnings yield is going to be, this is with the adjusted stock price due to the debt. I have it $2.38. So it would be 2.38% would be the earnings yield once I make those adjustments. And then I assume that will grow at 13% a year. So the first year on every $100 you invest, you would earn $2.69. And then each year that would grow. And what I want to know is how long would it take for you to collect $100 using this method. So that's what the spreadsheet's designed to do. And if we go here, we can see in year 15 is when you would turn $100 into 200, maybe 14 and a half, and so that number is right here. So in terms of comparing this to the rest of the market in S&P 500, 15 years time until payback is right where the S&P 500 is. So I would say that these estimates are probably what the market is roughly using to value the stock right now. It looks like it got a little bump here recently, so maybe there's some news. I don't know, maybe it's AI stuff, hardware, I'm not sure. Person could do more investigating to see kind of what this little bump is all about. Maybe they reported earnings or something too, I didn't check. But basically what I would say is the stock is valued about the same as the S&P 500, but probably has a little more downside risk if there's a industry weakness or a recession or something like that. So not super attractive to me here, but I mean, there is a situation, especially coming out of a recession. This would be the type of stock that if I had a bunch of leftover cash, that I would probably look to buy, because at that point I could see, okay, they've made a bottom. I can see where that bottom is. I can kind of see where earnings are at. And so that downside risk is then lower. And then if I have extra cash that I wasn't able to get invested, and it looks like we're coming out of a downturn or a recession, then this is the type of stock I would probably go buy, because they get knocked down a little bit harder. But then once the recovery starts, it's still a quality business, it looks to me like. Then they'll come back pretty strong. So let's say you don't pick the bottom of that initial March decline, but let's say you buy it in the summer, or even the fall, September here, and then you hold until today. Okay, so September 2020, you missed the crash and everything, and you have a bunch of cash left over, and you're like, okay, we kind of see how the market's treating this one. If you invested it, you could get a 15% CAGR from that point on. That's really good. That's fine. I mean, I know that a lot of the market has done well since then anyway, but that's good considering you would have missed the bottom, right? And if we had a real recession, those returns would probably be better. So, all right. If you found this useful, hit the subscribe button. If you have a request, put it down in the comments. I'll get it on the chalkboard behind me. I'm running a little behind on requests this week. I've been a little slow with the videos. I'm going to try to make sure I do some this weekend. And some of these have been a little tricky, and I've debated on how I want to do the videos, kind of like with CDW, but I will eventually get a video for you. All right. I'll see everybody later. Bye.